If you're planning to retire before the traditional age of 65 and before you're eligible for Medicare, you're probably worried about what you're going to do about health insurance coverage in that gap period. In this video, we're going to talk about the premium tax credits you might be eligible for if you are savvy with your tax planning in those early years of retirement. So make sure to stay tuned and make sure to subscribe to the channel if you are planning for retirement and you want to maximize your spending, pay less in lifetime taxes, and worry less about the financial markets. We put out weekly retirement-related content specifically designed for you, who I like to call PFR Nation. But first, my name is Kevin Lau. For those of you that are new, I've been helping people plan for retirement, real retirees, for almost 17 years. And one of the top concerns that I've seen across the board is healthcare costs. And especially for those that are younger than 65. It is just about 90% of the folks that I talk to that are younger than 65, they have this mindset that they want to work until 65 just for health insurance, that health insurance bridge period. But did you know that keeping your modified adjusted gross income in check could potentially reduce your healthcare costs during that gap period by thousands of dollars on an annual basis to help you offset those costs? So we're going to talk about all of these things in the video, everything you need to know about the ACA, the premium tax credits, who qualifies, when you qualify, and ultimately some of the strategies that you can put in place to keep your modified adjusted gross income down. But first and foremost, I want to talk about what is on the whiteboard here. So ACA premium tax credits. ACA stands for the Affordable Care Act, also known as Obamacare. And this video is going to address policies that are purchased on the ACA, on the healthcare.gov marketplace. The OBBB is the one big beautiful bill. And I put this in here because it is a very good there's a very good chance that at the end of 2025 rules can change around this. So make sure to stay tuned on the channel. Make sure to subscribe to the podcast. We're going to be continuing to readdress this topic, especially as these policy changes become legislation. Because it's very likely that something is going to happen with the tax cuts and something is going to happen as it relates to these ACA premium tax credits. But first and foremost, why don't we talk about who qualifies for the credit? So as I just mentioned, we're talking about policies that are purchased on healthcare.gov, purchased on the exchange. Okay, so each state has its own exchange, and it's all facilitated through healthcare.gov or the Affordable Care Act. And I'm going to show you actually what the website looks like later on. And I point that out because if you Google ACA healthcare insurance or healthcare.gov, if you put that into Google, there might be 2, 3, or even 4 sponsored links that are not healthcare.gov that are completely different. And so just make sure you're going to the actual healthcare.gov website. Like I mentioned, I'm going to show you some screenshots later on in this video. But so that's number one, is it must be an ACA plan. Number 2 is your modified adjusted gross income must fall between 100% and 400% of the federal poverty line. And we're going to talk about what that is and what that means, but we're also going to talk about a piece of legislation in 2021, the one of the COVID relief packages that was passed in 2021 that essentially extended premium tax credits even for those individuals that are 400% or above. So before there was a cliff. Once you earned $1 more modified adjusted gross income over and above 400% of the federal poverty line, in the old rule, 0 premium tax credits for you. Now it's a gradual phase out. So it's not a cliff, it's a slope down to 0. So that's number 2, is your modified adjusted gross income must be between that range or slightly above. We're going to talk about what that means in a second. Number 3, your tax filing status must be single, married filing jointly, head of household is I think is okay as well, head of household, but it cannot be married filing separately. So just an important caveat there. And the number 4, running out of space, is you are not eligible for other health insurance, okay? So this is key. So if you have an employer plan that is an eligible health insurance plan, you're probably not going to be eligible for ACA premium tax credits, even if you buy a policy individually or buy it on the exchange. So just kind of qualify who is eligible for these potential premium tax credits. So let's talk about how these tax credits are calculated. Essentially what they have is they have this expected contribution amount, okay? Or the expected contribution rate relative to your modified adjusted gross income. So as we mentioned, they're going to look at this modified adjusted gross income number, and we're going to talk about how that's calculated here in just a second. And and just a quick little preview on that one. It's not your taxable income, so it's not income after deductions, and it's also not your adjusted gross income. It's your modified adjusted gross income. So it's basically your adjusted gross income and adding back a few things that are typically left out of adjusted gross income. So we'll talk about that in a second. But we mentioned 100% to 400%. This table shows what the ECR, expected contribution rate is based on the percentage of the federal poverty line. So if you are less than 133%, your expected contribution rate is 0. So essentially you're going to have free health insurance. Okay. If you're just under 200% of the federal poverty line right here, your expected contributions rate is going to be somewhere between 0% and 2%. And then what they do is they benchmark that amount. So they benchmark your modified adjusted gross income, and then the percentage that you would end up contributing, or that the maximum dollar amount that you would end up contributing to a health insurance policy. And then they compare that to the benchmark plan. Okay, so the benchmark plan, what that is, it's the second cheapest silver plan. So there are 4 tiers. You have bronze, silver, gold, and platinum. And essentially the bronze plans, they're going to have the lowest premiums, but they're going to have the highest deductible, and therefore the more out-of-pocket cost when you go see doctors and use your plan. Versus the platinum plan is going to have a very low deductible, or even a no deductible, and you're going to have lower costs out of pocket ongoing, but as a result, you're going to have the highest premiums. Okay, so they're looking at the silver tier and the second cheapest in the silver tier. Don't ask me why, but that's what they call as the benchmark plan. So as you can see here, right now, if you're over 400%, there's no longer this cliff. Before there used to be a cliff, so no premium tax credit. So that is going to be very important to keep in mind, is that going past 2025, we could go back to the cliff. I think it's very, very likely that there could be a cliff, and you essentially have a 0%, 0% premium tax credit if your income, your modified adjusted gross income, is over 400% of the federal poverty line. But in this case, we have this 8.5% number is where it caps out at. So we're going to go through what all of this means, but this is in short how it's calculated on the back end. Now the question is, what is included in modified adjusted gross income? So I just mentioned before, it is essentially your adjusted gross income, your AGI, plus tax-free interest, plus non-taxable Social Security. Typically, these two sources are not included in your adjusted gross income, which is fine. However, if you are using this modified adjusted gross income number and ultimately how they facilitate the dollar or your income totals into this calculation, you have to add those back. So for those of you that are doing some strategies around, buying municipal bonds, that would be tax-free bonds at the federal level, and sometimes even at the state level, that interest income, maybe it's $10,000 or $20,000 or even $30,000 a year, is added back to your adjusted gross income for this particular calculation, as well as non-taxable Social Security. So for those of you that are familiar with this, your Social Security could be 0% taxable, but it could also be upwards of 85% taxable. So if your benefit is, let's say, $30,000 at the, your gross benefit is $30,000, it's potential that 85% of that could be taxable in your adjusted gross income that particular year. So 85% of 30,000 is somewhere in the neighborhood of 25K. So $25,000 could be included as your taxable income, whereas that other 5,000 would be non-taxable. Whereas in this calculation for, the modified adjusted gross income, we want to add these two sources back. So that's the simple way to look at it. But if you want to look through these sources, pause the video, and these are the ones that do not count as your modified adjusted gross income. Okay. So what is the federal poverty line? Most of the states and DC use this column here, and it's based on the number of individuals in your household. So if you are single, you're going to be a family of 1. If you are married, you're going to be a family of 2. If you are married and you have a dependent, maybe it's an adult child, or maybe it's maybe it's a parent that's a dependent on your tax return, you might be a family of 3 or more. Okay, so this is the number they use as the federal poverty line. You would sort of compare that to what your modified adjusted gross income is. So again, if we kind of look at the old rules, 400% times 15,650. So typically what you would see is somewhere in the neighborhood of 15,650 upwards of 62,600. you could potentially qualify for a subsidy. However, as we just mentioned, the COVID relief package in 2021 essentially extended this, and essentially instead of a cliff, now we have a gradual slope. So an example here. So let's say we have a married couple, so 60-year-old male and a 60-year-old female, okay? And let's say they have $60,000 in pension. And let's say they have $10,000 a year in taxable interest. But they also have $15,000 a year in muni interest. Okay. Maybe they have, let's say, $20,000 in capital gain distributions. Okay. So now what are we at? We're at 70, 90, 105. But then they want to do some Roth conversions. So they're also doing $45,000 in Roth conversions. Okay. And that could also be IRA distributions, basically a taxable IRA distribution. So if we add all these sources up, okay, 60 plus 10, that's 70, 85, 105 plus 45. Now we're at $150,000 would be the modified adjusted gross income. MAGI. So $150,000, if we compare that to the previous slide, if we compare that to a household of two, and we've got 21,150, multiply that by 4, roughly we're going to say 85,000. Well, 85,000 is way under 150K. So in the old law, this individual would be completely phased out. But let's actually look at this example. If we go on the exchange today, which again, like I mentioned, is healthcare.gov. And you don't have to sign up or log in for anything. You can essentially just go in and to healthcare.gov and say browse plans and costs. And then you're going to type in your zip code. Okay. And it's going to take you to your, to plans that are offered in your particular state as well as your particular county. And then you are going to tell them about your household. Okay. And in this case, like I mentioned, we've got age 60-year-old male, age 60-year-old female, no other dependents. And we've got a modified adjusted gross income estimate of $150,000 for 2025. And this is key. This is expected income. Now, it's a little different. If you think about IRMA, income related monthly adjustment amount, they look at your tax return 2 years prior, and that's what they're going to charge you if you're subject to IRMA for income related monthly adjustment amounts, Medicare surcharge tax. Okay, so we've done a video on that one before. If you want to go check on the Whiteboard Fireside Chats, if you search for will I pay IRMA in 2025, I did a full breakdown on that as well. But also, if you had a life-changing event since that tax return came out, maybe it's retirement, or maybe it's a death of a spouse, or maybe it's recently got married, you could go back and you can essentially appeal IRMA. So I also did a video on that as well, both on the Whiteboard Fireside Chats playlist. So check out will I pay IRMA and can I appeal IRMA in 2025. But in this case, we're looking at expected income for the year. And so if you're totally wrong in a bad way, meaning you put down, let's say you put down 50K and you're getting a lot of premium tax credits, and at the end of the year it's 150, well, you're going to owe probably a good chunk of change come tax time. Just keep in mind, this is an estimate, but we can dial this in pretty nicely. You can calculate your pension, you can put in your estimated taxable interest, capital gains, et cetera, et cetera. But in this case, 150,000 is what we're going to use. So as you can see, it'll just spit out what the estimated monthly tax credit is going to be. And in this couple, even though their modified adjusted gross income is way in excess of 400% right now, they're going to get a tax credit of $1,074 on a monthly basis. Okay. And how did they calculate this? All right. So how did they figure this out? So what they did, remember we talked about the silver plan, and we talked about the second cheapest silver plan. And if we look at this one, it's $2,135 on a monthly basis. So if you multiply that number by 12, that gives you $25,628 approximately, and some change, okay? But if you take, remember that 8.5% number? If you take 0.085 multiplied by 150K, the total contribution amount, their expected contribution amount, is $12,750. Okay. way below this 25,628 number. So what you're going to do is you're going to take this number subtracted by this number, and that gives you a total of $12,878 equals premium tax credit. And if you divide this number by 12, that gives you $1,074 tax credit on a monthly basis. That's essentially how it's calculated if your income is in excess of that 400% level. But if it's lower than 400%, your expected contribution rate may be lower. Maybe 3%, maybe 4%. Okay, going back to this chart, like I mentioned earlier, if you're less than 150% of the federal poverty line, you might be at 0%. Now, I will say, if you are too low, okay, depends on your state's Medicaid rules, but if you're too low, you can actually qualify for Medicaid and potentially get free insurance, but you need to be careful with that too, okay? Because, each state has their own rules with this one and qualifying for Medicaid, and do you even want a Medicaid plan? So just really keep in mind that if you are looking to buy an ACA policy and not go on Medicaid, you need to make sure your income is, you need to show some kind of income, okay? So another question is, when do you potentially phase out of the ACA premium tax credits under the current law? Okay, so we just looked at the second cheapest silver plan. Let's go back to that real quick. Was $2,135.68. So if we take 2,135.68 and multiply that by 12, that gives us 25,628.16. Okay. So what you would want to do is you want to divide this number by 0.085, and that's going to give you a total modified adjusted gross income amount of $301,507.76. So this is when essentially you're phased out of premium tax credit. So you can earn a fairly high modified adjusted gross income number. And think about someone who's retired. You may not even earn any wages. Maybe you're both fully retired, you and your spouse. You're not even on Social Security yet. Maybe the only income you're taking from your portfolio is from your taxable brokerage account, and you're keeping, maybe you're taking out $100,000 a year, $150,000 a year, but some of that is return of basis, some of that is a capital gain. Maybe you're doing some tax loss harvesting on top of that, so you could keep your income fairly low in these years. So even, $150,000, in my opinion, if you have substantial assets and you have your assets in the right places, you can even have room for things like Roth conversions or, getting aggressive on taking some of those distributions early on and still get these premium tax credits. But 301,507 is essentially when you're phased out completely in 2025 under these assumptions, age 60-year-old, married couple, household of two in Hamilton County, Tennessee. So if you plug that number in, if I plug in 301,507, which is essentially 76 cents less than the total phase out, as you can see, now the phase out goes to $1 per month. So essentially you're completely phased out at that point in time. Now I will say, like I just mentioned, keeping your income low, keeping your taxable income low, it's very tempting to kind of defer things like Roth conversions and tax, claiming Social Security just for the tax savings on your plan. So just kind of say, I guess I'm saying is, don't let the tax tail wag the dog. But let's say you're very thoughtful on this one. Let's say you are getting super aggressive with keeping your taxable income down. Maybe you're the same 60-year-old couple, but maybe you don't have a pension. Okay. So that's at zero. And maybe maybe you've got some interest income. So maybe your interest income is $20K per year. Maybe you've got some muni income, right? So muni bonds. That's not good. So muni bonds, maybe that's 20K. So now we're at 40K. Maybe you're doing capital gain distributions, from your taxable brokerage account. Maybe you're taking out 100K a year from that, but maybe 20,000 is a capital gain. So now we're at 20K is let's call it long-term capital gain. And, so that's 20, 40, 60. And maybe you're doing, $30,000. Maybe you're doing some Roth conversions. Okay. 30K. Now your MAGI, what is that? 90K. So if we look at $90,000, again, it's above the federal poverty line, above 400%. So you're going to be at that expected contribution rate of 8.5. So if we take 0.085 times 90K, that equals 7,650 is going to be your total contribution, your total annual premium amount. So again, if we look at this one, the total premium, the silver plan, 25,628.16 subtracted by 7,650. Now this person's, their premium tax credit, $17,978 on an annual basis. And now their premium is only $7,650 per year. And 90K, I'm telling you right now, we work with most of our retiree clients are far in excess of 7 figures. Most of them are multiple 7 figures, and they have a nice chunk of change in the taxable brokerage. And that is, in my opinion, one of the levers you can pull early on in retirement. Because again, even that $100,000 example, taking those distributions and paying capital gains on 20K, that's pretty conservative. Because again, what you can do early on is tax loss harvesting, build up that war chest to offset some of those capital gains into the future. So I guess in short, if you decide to receive the premium tax credits up front, make sure you're doing thoughtful tax planning. Make sure you are as close as possible to what you think your modified adjusted gross income is if you elect to receive them up front. You don't have to do that, by the way. You can just pay the sticker price, and then when you file your tax return at the end, you can rectify if you owe or if you potentially get a refund. And those premium tax credits could essentially benefit you on the positive side if you elected to not take the premium tax credits up front and elected to wait until tax time if you qualify for them in the first place. But smart tax planning is so key, and really thinking through timing of things like Roth conversions or the timing of Social Security or capital gain distribution. So making sure your investments in those brokerage accounts are not spitting out unnecessary capital gains, making sure you're doing tax loss harvesting, okay, and making sure you're tapping into potentially some tax-free withdrawals. Maybe it's an HSA, maybe it's Roth accounts, okay, and really thinking through other earned income potentially. Maybe it's part-time income from you or your spouse, or even full-time income from you or your spouse. Thinking through how all of these things could potentially impact what you're paying on health insurance costs, because you can really keep those expenses really, really low. And then once you qualify for Medicare, then it's a completely different ball game. But with that being said, don't let the tax tail wag the dog, okay? If Roth conversions are a good fit within your plan, don't completely avoid them just to receive the maximum possible premium tax credits, because the premium tax credits are temporary, okay? The Roth conversion impacts could be decades of a benefit for you, if not multiple decades and multiple generations to come. So just because doing something now, whether it's a distribution on your brokerage account, or maybe it's claiming Social Security, or maybe it's doing Roth conversions, just because that might add to your modified adjusted gross income doesn't mean you shouldn't do those things just to get the maximum premium tax credits. Because again, you don't want the tax tail to wag the dog. You want to develop a plan and implement the plan, and ultimately just know how things are going to impact your Affordable Care Act premiums if you do qualify for those. That's it for today. I hope you guys found it helpful. And if you did, make sure to like the video. Make sure to subscribe to the video if you're finding value in this, because we put out weekly related content specifically for you. And also make sure to share this with someone else who's kind of going through this similar situation. Maybe they're planning to retire before 65 and they're concerned about health insurance. Share this video with them, because that allows us to help and impact more people, which is really our goal on this channel. That's it for today, everybody. I'll see y'all next week. We've got some really great podcasts coming out, so make sure to follow our podcast wherever you consume podcasts, and the Whiteboard Fireside Chats. We're going to continue to release those every Thursday. So appreciate everyone's support. Until next week, this is Kevin Lau signing off.